trouble is on some of those CMBS issues, you don't necessarily know what the full contractual position is before you buy the notes on the market. And there's often some quite deficiencies in the documents, which can sometimes work to your advantage, but sometimes against you. And then you're constrained by all the sort of interrelationship of the different jurisdictions. So we find that the people looking to buy those sort of B notes in that structure for existing CMBS are more the sort of hedge funds, where there's no sort of income component to the total return, and it's very much just like an option they're buying effectively to see where the position leads to. Equally, we're finding on sort of more clients looking at newly originated CMBS as potentially something that's interesting from a return perspective, because it's based off current values, it's compliant with CMBS 2, which gives investor more protection. So you can actually get, if you take a view at what level in the priority you come in at, you can actually get better, good income returns.
And just in terms of that, in terms of the documentation side, then does that mean there's no way, if that information isn't there, there's no way of mitigating that risk? That's only really you're taking a bet on the fact that it's a lower value.
Well, some of the old CMBS, a lot of the underlying documents weren't made fully public. So, for example, you might buy some notes in a tiered structure, but not actually be fully aware of the terms of the intercreditor agreement, which is fundamental as to how you can exercise your rights. And that's been one of the problems. And quite often you wouldn't know who the bondholders are. Now, CMBS 2, as characterised, seeks to address all those problems by requiring much more sort of information to be available.
There has been this sort of belief or myth that note holders and CMBS can never get together and decide on anything. But haven't there been sort of more successful restructuring now?
There have been definitely, but over a period of time. And obviously, what happens is the notes are held by a whole range of disparate investors. Mm-hmm. When people buy, no one will know who owns those notes, and it takes a long time. And often, for example, like on Deutsche Annington, where there was a restructuring last year. A deal was done where certain debt was forgiven, the margins were increased, there was an extension of the tone, a sort of and a profile for repaying part of the loan, part of which had been achieved by a subsequent IPO. But the mezzanine note holders who bought in at a certain level took the view that they were being underpaid on the new margin based on market comparables at that time for their level of risk. But they were locked into it because of certain deficiencies in the documentation, which enabled Deutsche Annington to sort of push the proposal through a scheme of arrangement.
And Joss, is that something you've come up against when you've been looking at product, looking at portfolios?
Well, no, just some of the funds and situations we've taken over, having acquired managers or been replaced, come in as the new replacement manager on the fund. All these things happen. You know, we've got an asset in Spain where we've got a securitized structure. We've had Lone Star buy a loan, interestingly, out of the Excalibur process. We've had Marathon buy a loan out of the Lloyds process. So, we're very familiar with it.
And for you, that's not necessarily an issue. It's just an understood risk that you're taking when you're making that purchase.
Yeah.